Now, Reliance Industries, the stock is up over 20% in the last 6 months, and the numbers are expected to be good across all segments. So first, let's give you the key expectations in terms of the core numbers. On the revenue front, we're expecting a 15.5% growth on a quarter-on-quarter basis. The core EBITDA will also grow up about 10.5% or so, coming in at 28,700 crores. A slight dip in margins is what the street is expecting this time around, but the profitability will rise. Now, the important thing for Reliance Industries this time is that there will be a sequential improvement across all segments for them, but the key positives will come in from the petrochemical and the telecom vertical. Now, just to give you a sense, Nomura is expecting the oil to chemical EBIT to grow 21% on a quarter-on-quarter basis. Now, the oil to chemical business is expected to do well, driven by a big improvement in the refining business this time around. Not just that, the E&P segment is expected to do quite well as well because of a nearly 70% hike in gas prices from the 1st of October. Now, coming to telecom. Within telecom, both the average revenue per user and the number of subscribers have gone up. There's a nearly 6 million rise in number of subscribers that we've seen for Reliance Jio, and the average revenue per user will go up from 144 rupees to 148 because of the recent tariff hike that the company has undertaken. Retail too is expected to do well, but three key monitorables. Reliance has been investing in a big way in the new energy business. Any more acquisitions or investments is something that the street will watch out for very closely. Apart from that, they're also looking out for any growth in retail store additions because now post-COVID, the retail market has come back in a big way. And finally, any more tariff hike in the telecom space is something that the street will keenly watch. But the stock has done quite well for itself in the last 6 months.
It's expected to be a steady quarter from Reliance Jio this time, driven by subscriber growth, which is seen ahead of peers, and a price increase. So revenue growth will be seen up 3 to 3.5%, and this is driven by a subscriber growth of about 6 million this quarter. Now, if you look at the TRAI data for the month of October and November, Reliance Jio has roughly added 3.8 million subscribers, which is ahead of peers. Now, there was this Jio Phone Next launch, the affordable smartphone, which was launched around Diwali, and that is expected to drive subscriber growth even more in the month of December, which is why the street is expecting a number of close to 6 million. The other factor which is going to work in favor of the numbers is the average revenue per user or the price increase by 3.5%, and that is because the industry took a price hike of nearly 20% effective 1st of December. This price increase will also flow through into the margins, which is seen up 50 basis points to 48.5%. The profit figure, according to the poll, is down about 2.5%, but the estimates range from all the way down to about 3,200 on the way down to 3,700 on the way up, and it depends on how much you expect the company to amortize on the spectrum cost as well as the interest payment.
Well, for Reliance's retail vertical this time around, where there will be some sort of festive recovery as well as a growth booster coming in, and this time around the street is working with a near 9% growth in terms of their revenue quarter on quarter, just shy of that 50,000 crore mark. That's what Nomura is expecting, and it will be more telling on their operations as well. 15% jump is what the street is working with this time around. What does that mean for their margins? A 40 basis points improvement in the EBITDA margins. Year on year as well, we'll see a near 35% growth in Reliance Retail's revenue. Importantly, over the last couple of months, we've seen them make a handful of important acquisitions from a future standpoint. 25.8% stake purchased in Dunzo, near 54% stake purchased in robotics company Adverb Tech. So any commentary around that will be extremely crucial to watch out for as well. And the revenues will be further aided by the 7-Eleven stores that they've opened during the quarter and the Jio World Drive Mall. Importantly, the company has also opened 813 new stores in the second quarter. So store openings will be monitored in the third quarter. 91 new supply chain locations. So that will be, a backbone for their future growth as well. And footfalls in the second quarter were at 78% of pre-COVID levels. The street expects this to exceed pre-COVID levels in the third quarter, just before Omicron hit and the festive season demand did go ahead and boost those footfalls.
Well, oil to chemicals business for Reliance Industries this time around is expected to see a strong sequential recovery, and it will be driven by the refining segment. So let's talk about that first. Now remember, Singapore refining GRMs, they have actually improved on a quarter-on-quarter basis. They have doubled to levels of $6.1 per barrel, which compares with $3.7 per barrel in the quarter gone by. And for Reliance Industries itself, gross refining margins are expected to see improvement of $3 per barrel on a quarter-on-quarter basis to come in at $10 per barrel. barrel. Now that is not it. Even the refinery utilization, that is expected to increase to 105% in this quarter, which compares with 100% that the company saw in the year gone by and 98% on a quarter-on-quarter basis. If we look at what the Petrochem business will do, yes, there will be better chemical margins because of higher prices and also because of improved margins. However, we did notice that the gas prices had gone up substantially, and that is something which will cap the margin improvement in the near term. Now, overall, Morgan Stanley is expecting the O2C EBITDA to come in at 13,989 crore rupees, which is an improvement of 10% on a sequential basis and 43% on a YOY basis. Now, we'll see the chain, how the margins have really improved for the company, that is the O2C EBITDA, from levels of 8,800 crores, which the company saw in Q2 of FY21. It is now sitting at 12,720 crore rupees and expected to improve further from here on. Now, focus will also be on the oil and gas business, which has not been doing well for so long, but this time around, domestic gas prices which have risen, they should support a turnaround in the EBITDA for this particular business. Morgan Stanley expects EBITDA to increase to 1,500 crore rupees, which compares with 1,071 crore rupees, which the company reported in the quarter gone by. Overall, both the businesses, oil to chemicals and oil and gas business, they should see some strong recovery on a quarter-on-quarter basis.